What's going on, man? We're gonna start in about 10 minutes.
So I'm gonna just chill in here so I don't miss it.
Sweet. Okay. Okay, we're gonna start in about a minute. All right, good morning, Checkmate crew. It is 10 a.m. Eastern Time, 30 minutes after the New York Stock Exchange open. It's me, Mickey Blindside, with your market memo today on Wednesday, November 9th, 2022. Hope everyone's having a good morning. Okay, so today is the day after midterms. First, before we get to midterms, let's talk about crypto. Everybody's talking about crypto right now because of the crypto crash that happened. So let's start with that. We had a huge, a pretty large sell-off in the crypto market. Here is our Ethereum chart. There was a liquidity crunch scare involving the FTX exchange. It's the crypto market right now is still the Wild West. Basically, CZ, who is the head of Binance, had been acquiring billions of dollars worth of FTT, which is FTX's collateral token. And then all at once, he dumped it all onto the market. And so the price of FTT, which is their internal collateral, that price fell, and FTX's bank demanded more cash as collateral. Now, FTX and Sam Bankman didn't have the cash on hand, so he sold the company to basically, save his customers, which was, a good thing for him to do. But he actually sold it to his attacker, who is CZ. So, Sam, he didn't have to do this. If he had put his ego before his customers, then this outcome would have been very, very different, And I said this in the Discord yesterday. Sam was playing checkers and CZ was playing chess. This was an attack. This is like the robber baron days of the 19th century. This is just Jay Gould versus Cornelius Vanderbilt all over again, but in the crypto market. This happened before in the robber baron days, and usually this kind of stuff happens around a bubble. During that time, the railroads were at a bubble. Right now, it could be argued that crypto's in a bubble, but these types of attacks are illegal here in the United States in the stock market. It was made illegal during Teddy Roosevelt's administration. But again, the crypto market is still widely unregulated. It is the Wild West, so these things happen. With the expectation that the midterm election is going to create a split government, I actually don't think there's going to be any regulation that comes out of this for the next 2 to 3 years. So this kind of thing may still keep happening. There might be some consolidation in the crypto market around this. So yesterday when let's talk about the actionable things. So yesterday, while it sold off, remember the plan was, I sold some Ethereum at 1650 and I used the proceeds to buy at our green line. And with all the, you remember, if you guys remember back in the summer, we bought at 1241.46. We sold a third at 1650, and I said I was going to take those proceeds and buy at the green trend line. So, which I did. It was around 1300 where I reloaded some of the long position. So my cost basis turned out to be $1,139.25. That was my cost basis. Actually, it was a little bit under that. It was like $11.39 and like 20 something. But okay, let's call it $11.39 and a quarter. And that is where I placed my stop. And overnight, while I was preparing for this, boom, our stop hit. Literally, I couldn't make this up. Literally, it went 50 cents below my stop and then just bounced up. So go figure. That was my break-even point. So literally, I just broke even for all of this. It is what it is. I still have some crypto exposure through my HUT holdings, so I don't really feel like I'm missing out. But man, it would have been nice to keep it. If it just hadn't done that undercut and overshoot, I would still have it. It would have been nice, but it is what it is. Now I'm just waiting for ETH and gold ratio. If ETH gold ratio, I think if it gets to around here, that's going to be a very good buy point. So I'm just waiting for that based on today's gold price. That turns out to be around 900, 950 zone on Ethereum. So I'm still waiting for that. I'll still go long there, but that now I'm just waiting for that major level. Okay. So I wanted to give you guys that update. ETH gold 0.56. That's where I go long. And again, now I don't have an Ethereum position anymore because I got stopped out at break even. So it is what it is. 30%, you know, they say if you do risk management right, I forgot who said it, was that guy that wrote that book, Trading Volatility, that expert market psychologist. His name is, I can't remember his name right now, but anyway, he said that if you're managing risk correctly and your stop triggers, there's about a 30% chance that it would have been better off not having the stop. But I mean, that's just part of risk management. I mean, 30% of the time when you place a stop or place a risk management level, yeah, it's going to be like, as you know, it's going to be as if it was better if you didn't do it. But that's 70% of the time, that's what protects you. And again, our number one job as traders is to protect capital. There will always be another opportunity. Always have the mindset of abundance. There will always be another opportunity. Okay, so I'm not too worried about it. That's crypto in a nutshell. Oh, speaking of crypto, you know, I thought during the sell-off I was going to acquire some GLP and some GMX as well too. This is something that some of our members, Mitch and MSC, you know, they've been really big proponents of this. And you know what? I was going to dip my foot into that. I dipped my feet into this, but it never sold off. GLP just didn't sell off. So I'll add that to my trading plan as well. Maybe we can get one of them on here and explain the thesis for the GLP GMX environment. I'll try to arrange that so that they can argue their thesis on that. So that is Ethereum in a nutshell. So that's that. Wild West. It is the Wild West in cryptos. Okay, now let's get back to the other markets of the day. Today, VIX is down, markets are down, dollars up, risk on currencies are down. That seems to be the opening theme of the day. Let's see if it changes or not. SPX, still nothing has changed. I'm still waiting on this level right here, 41.25, and I think if CPI comes out a little bit light, a little bit lower than expected tomorrow, I think that's a very good possibility within the next couple of weeks. If not, I mean, I guess we could sell off. Either way, I have a plan. I have a plan for what happens to the market if it goes up. I have a plan if the markets go down. If the markets go down, VIX gets to 32, I'm going to sell puts at the money puts 30 days out for assignment. That has been a very good trade this year. I've already collected about 30, 40 points or more per contract on just shorting VIX, just shorting at the money SPY puts, which is essentially what you're doing is shorting the VIX. So when VIX gets to 32, it's been a very good place to short the VIX. So if the market sells off, VIX goes to 32, I'll sell 30 to 45 days out at the money puts for assignment. And again, if we get to this 3,400 zone, I'll just buy some SPY shares outright in my long-term portfolio. And again, I'd really love to get that to go with QQQ puts when that happens, just because of our IVWIVE chart. IVWIVE is growth to value. It is still going down, which means in sell-offs, tech stocks, growth stocks are going to sell off faster. In rallies, value stocks will probably end up doing better in rallies. So if you're going to play a bear market rally, definitely go for a value name. If you're shorting the market or shorting, if you're just expressing overall bearishness, growth stocks, puts on growth stocks is the way to go based on this indicator. Speaking of indicators, let's look at TIP TLT. TIP TLT is all over the place, okay? Is this the new no man's land? Is this the new box? Just like we had here, we formed a little, I guess you could call it a Darvis box right here, right? Is this a new Darvis box for the overall trend? I don't know. If we want to see this, if we want to see IVW, IVE flip up and start seeing a growth outperforming, we really need to see TIP TLT drop. And I suspect a big move will happen in this when the CPI report comes out tomorrow. You know, if it comes out a little bit lighter than expected, then I can see this selling off. But if not, then I mean, I guess it will keep on marching higher. But in order for growth to outperform, I do think TIP TLT needs to break down. And in order for TIP TLT to break down, what we need to have is TNX breaking down, okay? So again, these interest rate charts and bond market indicators are very important, not just for equity traders, guys, also for the crypto traders out there. You know, a lot of this macro movement and a lot of risk on, risk off is going to be expressed in the bond market first before any of these other markets. Even compared to the stock market, you know, the bond market is the bigger brother. It is a way bigger market than the stock market. And then crypto market is like, I don't know, it's pretty much a speck of dust in the wind compared to any of those markets. So again, you know, a lot of the risk on, risk off is going to come through the bond market first. So keep an eye, even though you don't trade bonds, you know, and even though you don't trade equities directly, if you crypto trader out there, still bond market, this is where you're going to see the risk on, risk off. Bond markets and currency markets. And again, right now, there is a record amount of dollars in dollar-denominated accounts in overseas, foreign dollar accounts. So a lot of that is in Europe and in East Asia. So basically, you know, European investors in Europe or Asian investors in Asia, you know, if you're wealthy enough or if you're institutional, you can open up dollar-denominated accounts over there. And right now, the yields on those dollar-denominated accounts are really good. They're actually better than a 5-year Treasury rate from what I've heard. One of my buddies overseas has one, and he told me he was getting a better rate than the 2-year Treasury. So right now, there's a lot of dollars locked up in that. And I think one of the forward-looking indicators is going to be the British pound, the euro, and the Japanese yen. If we see the British pound advancing, the euro advancing, and also the yen advancing at the same time against the dollar, I do think that we're going to see some of that money rotate into risk assets, okay? That liquidity needs to find a home somewhere, okay? So these are our foreign-looking indicators. Oh, I didn't notice this before, but it looked like the British pound was trying to made a higher low, but it couldn't make a higher high. Interesting. Is it going to form a box first before there's a trend reversal, or will it form a box and continue its trend? That remains to be seen. And until we see that, I don't even think we can play a bear market rally until we see something like that, okay? So I'm keeping a close eye on the British pound. Again, the euro as well, too. The euro also, I think, is a risk-on indicator. There's a lot of money in Europe because of the slide in the euro. A lot of European institutions put money in dollar-denominated accounts. And again, if we see this, if we see those dollars getting used to buy euros to get into risk assets, again, I would think it would probably give us a couple of days head notice before we see broad rallies across risk assets. Japanese yen, it is starting to come up a bit. Most of you guys are probably looking at the USDJPY chart rather than the JPY USD. I like to use the JPY USD just because it shows what the foreign currency is doing. You know, if it's going up, it's advancing, it's going down. It's an inverse chart if you're putting the US dollar first. But most of you guys, you know, with Forex accounts, you guys probably see this chart. This chart needs to go down in order for this chart going down means yen is going up. But you know, the yen also coming up would mean that a lot of Japanese investors are taking dollars out and getting into risk assets as well. So Japanese yen, British pound, euro. Keep an eye on those. Okay, and I think those are going to give us a couple of days head start. Speaking of, you know, we're comparing all of these to the dollar. The dollar is it looks like it's trying to do a trend reversal. And again, remember right here, remember in end of October, I said it was the first daily chart lower low since 2021, okay? And it made a lower high. And let's see if it actually did it already make a lower low. Low 109.366. It did make a lower low. So it made a lower low, lower high, and another lower low. Barely, but still, that's a lower low on a closing basis. So we are now in a full-on daily chart downtrend in the dollar. Interesting, okay? I don't know if the currency market is front-running CPI. If CPI comes out pretty light, that would be pretty interesting. That means the dollar front-ran all of that. That I think that has certain implications, but I won't share that until I'm 100% certain that that's the case. We don't know until tomorrow. Actually, even after tomorrow, I'm going to have to get data to confirm all that. So it'll take a couple days to confirm all this, but I'll let you guys know once I see that. All right. If that's the case, if the dollar comes down, I do think TNX will then come down. Again, we have our indicator here, the copper gold ratio. This ratio chart really hasn't worked out for us. You know, let me compare it to TNX. Okay, let's turn it on. So since 2011 or so, 2011 or so, it has tracked very well. Our copper to gold ratio times 1,000, and usually when there are discrepancies like this, usually the TNX will catch up and follow the copper to gold ratio. Well, that hasn't happened yet. Okay, so I mean, if that does, if TNX drops, I mean, we could see the TNX drop. I mean, do I really think it's going to come down to 2.16? No, and as we're talking right now, the copper gold ratio is actually going up. Maybe they meet in the middle somewhere. Okay, I can see that. I can see the TNX if the dollar drops. Okay, that huge if. Okay, I'm not trying to predict the future. I'm just trying to anticipate what could happen. But it's very possible if the CPI report comes out light. And again, I don't even know if that's the case. You know, I'm just again thinking 5 or 6 moves ahead, like a good chess player would. I do think that it may come down. Maybe we might see around 3.5 or so. Maybe it meets around 3.5. Actually, let's scale it so that it's all scaled to the same. Yeah, let's scale it together. So yeah, I do think it may meet in the middle somewhere, maybe around here, 3.2, 3.5. Okay, it does a little bit of a retracement. I do think though, in the end, I do think after a few years, TNX will be a lot higher. I'm actually thinking, you know, I don't want to call it a prediction. Okay, I don't want to call it a prediction. I'm just anticipating what could happen. But I do think there is a possibility, okay, that within the next few years, we may see, actually, let's go to the actual 10-year bond quoted. But I do think that in the next couple of years, we may see, I think, on the low end, maybe 5.5 to 6%. I think more realistically, 675 to 725. Okay, I actually think that the TNX after a couple of years, probably after 2023, 2024, that's where it's going to be. Okay, but I don't know what path it's going to take. I think it's going to retrace down a little bit first and then march on higher. And again, the low end of my expectation, 5.5 to 6. I do think though. The more likely though is 675 to 725. Okay, that's going to have huge implications on fair value of the NASDAQ. All right, so if I see that is becoming a more likely scenario and it becomes more certain that that's going to be the case, I'll let you guys know what my fair value estimate is. It's all based on discounted cash flow. I mean, you could do it yourself. You could look up Google, download an Excel spreadsheet that already has a discounted cash flow all in it and plug in some numbers. But I'll go over that more when the time comes. And if that's the case, I do expect that this chart, the IVW, IVE, it may come down significantly, okay, if that's the case. If TNX goes up to like 6-7%, this is coming down. This is going to come down probably to around this like 0.3 zone. Okay, it's probably going to get to around this 0.3, high 0.2 area. Okay, so the Dow is going to be heavily favored over the NASDAQ if that is the case. All right, a huge outperformance of that Dow compared to the NASDAQ if that's the case. Okay, we saw something similar to this in the late 90s. Okay, and early 2000s, we saw something like this right here. Yeah. All right. As far as other bond market indicators, we got our junk bonds, ADL. Junk bonds is still stabilizing. All right. So liquidity is not worsening, but it is stabilizing. And again, this is not a MOAB. This is not a recommendation to buy or anything like that. But supports mean more. All right. And then also too, more market participants are willing to cash out their hedges if the junk bonds ADL is stable and that we're seeing advances in the junk bond market, okay? Because overall, the junk bonds is way bigger than the stock market, and it's the most riskiest part of the bond market. So when we see risk appetites increasing in the bond market, generally that risk-on appetite trickles into other markets as well, again, into stock markets and into crypto. So again, even though you're not a junk bonds trader, it makes a lot of sense to track this because it will help especially as a lie detector for risk assets, okay? So right now it is stabilizing. Are some of our other indicators, the New York high low, oops, I don't know why it glitched out there. New York high low is flattening out, and we actually saw some, I think we saw a very low negative number. Right now, the New York high low is at minus 63, so it's still declining, but it's declining less, all right? I think if we have a couple of positive advancing days on the high low line, we might get over the first moving average. But again, it takes a lot to get this over all moving averages. So it's still like weeks away, okay? So nothing too significant in the high-low line. The advanced decline line has been advancing though, all right? We are making higher highs and higher lows in the advanced decline line for the New York Stock Exchange. And then also too in the equal weighted S&P 500, we just fell. We are 1, maybe 2 days away from making a higher high on the equal weighted S&P 500. We'll see what happens at the end of the day. All these indicators, it's closing prices that are the most important. So those are the indicators that I'm looking at, and that's what I'm looking out for this week. Again, CPI numbers come out tomorrow before the market opens. Manage your risk, guys, okay? So if you guys have some shorter dated options plays, you may want to manage that risk. You may want to take some profits. Maybe you want to keep losses small, okay? So there will be bigger opportunities when there's more clarity in this market. This market has been very volatile. It chops people both ways. Remember, record high puts were bought here by retail in October. And they got wiped out. And then we had high tech call volumes, high call volumes in tech stocks right here just to have it sold off. So a lot of people have been, chopped up in both ways. Again, patience pays. There's nothing wrong sitting out and really waiting for the reward to risk to be stacked in your favor such that your losses are small, okay? So when you wait for these high level zones, for example, 41.25 to short on the S&P 500, that if it gets above there, closes above there for a day or two, you're wrong and you can just get out with a small loss, right? But here it's really hard to manage risk in all this middle. Okay, because if you short and it goes up just a little bit, well, you never know. It might just reverse maybe a couple days later. You don't know that. It's much harder to manage risk in what I call no man's land. But at the edge of price structure, that's when it becomes much easier to manage risk. Now, because of that, I may miss out on a lot of trades. Most of the trades that I track, only about 10 to 20% trigger. Most of them don't trigger because sometimes the markets don't the markets don't get tested all the time at the edges. Sometimes the markets just move in the middle for a bit and make their movements and big reversals in the middle, which is fine. I don't have to participate in every trade. Speaking of which, GDX, oh my goodness. Speaking of not participating, I literally missed out on my alert by 8 cents. This thing was a low at 22.58. I had my alert at 22.50. I thought I was being very generous with 22.50 as I was trying to buy around here. It just reversed on me. Look at that. It just went all crazy on me. Okay. So I am trying to get into some gold and silver miners. I'm pretty bullish on the precious metal story for the next couple of years. So I do want to get a position in. I was thinking, leaps, 400 to 800 day leaps on GDX, GDXJ, SIL. SIL is the silver miners. GDXJ is the junior gold miners, and GDX is the gold miner ETF. There's some gold stocks that I'm actually looking at too. Barrick Gold, I think, is a very good candidate. Very low debt, high cash, also in copper as well. I think this is a very good candidate for an individual, as an individual stock position as a gold miner. Very nice. This is the one that I found. This is one for silver miners. I'm also looking at First Majestic, which is ticker symbol AG. This also is, I think, a very good candidate for a silver miner. Both of these leaps are actually not that bad. Okay, the leaps market on this is not bad. So again, I'm waiting for that pullback. I really don't want to chase here. I really don't want to. Okay, and again, with that CPI coming out tomorrow, if it ends up being really hot CPI, I imagine the dollar is going to rally hard, and it may push gold down a little bit. So if gold gets, if AG gets, pushed down into the eights, the low eights, high sevens, I may go into it. Okay, that may be worth going into. All right. So I'm going to add that into my plan. Let's see what else. Oh, UUUU. We had earnings come out. The filing came out last week, but the earnings call was yesterday. And it was a great earnings call. The management team really laid out what their plans were. The increased cost. So, as we suspected, remember when the numbers came out and it was a bigger loss than expected, I said, hey, it's expected that they're going to have a loss right now because with the perception of increased demand in uranium in the next couple of years, they're going to have to restart and reopen their mines. Uranium mines aren't constantly being mined all the time. Uranium, the uranium players that have kind of a longer term vision, when the uranium market turns down and when prices are low, they end up closing the mines, and then they reopen it when demand picks up again, to save costs. But because they close the mines and then they have to reopen, there's maintenance that they have to do to reopen it, and also to the more staff that they have to hire to maintain it, to reopen all that. So there are some increased costs to reopening these mines. So it was expected that this was going to happen, and they laid out all the expansions that they're doing. They actually upgraded their mill as well. In Utah, they're also getting into rare earths and mining for those rare earths for magnets for electric vehicle and electric cars. So they're in that space as well too. They're one of the few miners for I forgot what the mineral was. I can't think of it at the top of my head. I think it was vanadium. They're one of the few miners of that here in the United States. I think it was vanadium, but they're actually in multiple rare earths. I think it was vanadium that was used in magnets for electric motor cars, but I'll check and I'll make sure of that. But anyway, they made some upgrades. They had some costs with that. I think UUUU is a great prospect for that. So not only are we playing the growth on the uranium market, I also think that this is a very great play for rare earths, and I think they're going to have a higher growth rate than some of the other pure uranium plays out there. CCJ is a pure uranium play. I do think UUUU has a better growth trajectory for the next 5 to 10 years over some of those more pure uranium plays because of the rare earth business that they are into. And again, they're used in electric vehicle cars. I think they have enough minerals on hand, or they can mine within a year to make, I think, 500,000 to 1 million cars. So that's a pretty good supply, and you know, and those rare earths are going up in price. So I think that should be some tailwind for UUUU's future earnings. And so I am still bullish on this. I'm happy to see it coming down. I do have a collar trade on UUUU. I have covered calls and protective puts. I'd really love to get out of these covered calls and have them go worthless. So I am hoping that, I am hoping that this comes down. And again, people think that I'm a permabull. I'm not a permabull. I actually end up making more on my swing trading during bear market, low liquidity markets, because selling premium and buying protective puts works really well in those choppy, low liquidity markets where price goes all over the place. That's really when it works very well. So I'm actually not a permabull. I actually make more during bear markets. Which is kind of funny, actually. It's kind of ironic, but it is what it is. Okay, so that is the market memo for today. That's what I had planned. Do you guys have anything you guys want to look at? I see some requests here. What is this? Oil. Oh, it's coming back down. I haven't checked the crack spread in a while, but right now it's winter, so it's winterization. We got to look at diesel prices. If diesel prices are going up, this is pure crack spread play. As diesel goes up, oil's going to go up. As long as there's a bid for diesel, oil will keep going up. My plan still hasn't changed. I really want to short here at the edge of price structure, because then we know when we're wrong and we can get out. Okay, for a very small loss. There's a common theme to my trading. If you notice, I wait for edge of price structure. I'm patient. If we get there, that's when I act. And if I'm wrong, I can get out at a very small loss. And if I'm right, we can enjoy really large profits. Okay, so that's the whole point. It's reward to risk. How much reward is the potential for the risk that I take? Okay, I want that risk to be small as possible for the biggest reward. All right. And so I think that edge comes around here in our price structure right here, around 120 or so. All right. And that's what I'm waiting for. Natural gas is something that always also has been asked about. Natural gas. Wow, that's crazy. Look at that movement. That's a huge movement. Actually, natural gas, what I want to take a look at is the European natural gas market. Because I think that's going to have a lot more bearing on the risk on, risk off sentiment here in the United States. So let's actually, or in just risk markets in general, let's just take a look here. I want to take a look at European prices. Hold on, let's go to Europe. The European one is the one quoted on the Dutch market. This one, yes. This one, this is it. Okay. So let's take a look at the weekly. So it does look like it's forming a little base here. Technically, this is still in an uptrend. Higher high, higher low, higher high, higher low, higher high, higher low. Does it go up again? I don't know. It could be. So one of our members is writing, I was reading that poor countries are having massive blackouts due to Europe's stranglehold on NG supply. Very, very possible. I mean, we've been seeing commodity prices spike in the emerging markets. I mean, we saw this back in, remember June, July, when there was all those, when all that flooding happened in Pakistan and India, and the rice market went crazy, and the food markets went crazy because of all the flooding in South Asia, and then China had record drought, so they had a low rice crop. But anyway, yeah, I mean, just the cost of the dollar itself, I mean, is making energy prices go up. We already saw rolling blackouts in Sri Lanka and Pakistan back in July and August. So this has been a phenomena that we've seen for months now, months. So this is nothing new. I guess the media is just getting around to it. But we here at Checkmate, we've been talking about this at the morning market memo and with the high noon highlights for months now. So yeah, I mean, there's going to be even more issues. If the dollar keeps going up, there's going to be even more issues. Okay, and I do think the dollar will go up. I do think that emerging market, and I told you guys this, I think emerging market, there's going to be a solvency crisis end of 2023, 2020, and beginning of 2024. That's when a big debt servicing payment is due from emerging market bonds, and they have to be paid in dollars. So, I do think around that time is when we're probably going to see some solvency risk in central banks in the emerging market. Probably at that time too, we're probably going to see another commodity spike. I do think we're going to see another commodity spike, probably 2023. I think it will probably start March or April of 2023. Okay. And all of that just kind of culminating together. Usually that's what starts a solvency risk. All right. It's all those things coming together at once. All right. Because nobody ever prepares for all these things to happen at once. All right. It's just human nature. Nobody thinks like all these bad things will happen to them all at once. But sometimes it does happen. Okay. And that's why these things happen, once every, few decades or so. But I think we are headed in that direction. It's going to take months and quarters for it to play out, though. Okay. But we're already seeing the cracks in emerging markets because of that. All right. Speaking of Europe, I know we just talked about Europe, Eurozone stocks. I remember I was laughed at. I told people that, hey, I don't want to short unless the DAX gets to like 13,800, 13,900. I said that back here when it was like under 12,000. When the DAX was under 12,000. I remember people laughed at me. My own members, they all laughed at me. They said, oh, that's never going to happen. That's a huge rally. That's a 20% rally. That will never happen. Well, look at that. We're close. We're like 2 or 3% away from my zone. Okay, I'm going to remain patient. I want the best fill possible. So I'm going to wait for that 13,800, 13,900 zone. Okay, everybody was laughing at me here when I said, oh, that's where I want to short. Well, look at me now. Okay, those who shorted too early, well, I feel bad for you, but I warned you. These are low liquidity markets. The counter trend reactionary movements in low liquidity markets can rip your face apart. Okay. The reason why I know this is because I know this from firsthand. Back in 2008, it was a very super low liquidity market. Okay. Back in 2008, we were in a bear market. Banks were failing. Liquidity was like really, really low. But guess what? We had days where we literally ripped up like 10% in a day. Okay. We had this 10% in a day, and everybody thought, oh, next day it's got to go down. Nope. It went back up again. It went up almost another like 7 or 8% after that in the next coming days, in the next like few days. Okay. This is what a low liquidity market looks like. The counter trend movement, again, 2008, the trend was down. Liquidity was low. The counter trend movement can rip your face apart. And that's why in the beginning of this bear market, even back in December, I warned you guys, more bears get wiped out in a bear market. Why? It's because these counter trend movements will kill you. Okay. I know this from firsthand. So, that's why in low liquidity markets, patience is super important. Yeah, you may if you chase price, yeah, you could win, but all it takes is one really bad trade, one wicked nasty counter trend movement to wipe you out. And again, as traders, our number one job is to protect capital. Okay. When I enter a trade, I always think to myself, what is the worst thing that can happen? And if I'm not ready to take the repercussions of the worst case scenario, I don't enter the trade. It's that simple. It is. It's that simple. It's discipline. It's patience and discipline. It really is. Trading is it's not about you versus the market. It's you versus yourself. It's you managing your emotions, okay? Because we are humans, after all, okay? So I hope that little bit helps. Any other questions? Anything else you guys want to look at? Going once. Going twice. Sold. All right. In that case, that concludes our session of the Morning Market Memo. Our Discord invitation link is in the description below. Come join our Discord. Be a part of our growing community. There are no sub fees, no paywalls. It's of the people, by the people, for the people. And if you enjoyed our video, go ahead and hit like, follow, subscribe, comment. Show us some love, baby. All right. I'll be back on tomorrow, 30 minutes after the New York Stock Exchange opens, 10 a.m. Eastern Time. Hope to see you guys then. Trade safe.